The Employee Retirement Income Security Act, ERISA, was enacted to preserve traditional pensions. Ironically, it instead began their decline. Companies that were judged by quarterly earnings decided they didn't want to guarantee their employees' retirement income 40 years into the future. And as this paper notes, guarantees are not free, and thousands of businesses decided not to pay their price. As a result, market risk and longevity risk have been transferred from employers to millions of individual employees. Employees who are, almost without exception, woefully unprepared to assess these risks and make choices about them. This transition from guaranteed retirement income proceeded on many fronts. We've already noted the switch from defined benefit plans to defined contribution plans. But even for the 40 million people who are still covered by private defined benefit plans, more than 10 million of them are in hybrid plans, whose benefits are not fully guaranteed. They vary to some extent with the markets. And within 401ks, the use of annuity options, i.e. guaranteed income options, has declined. Indeed, the word annuity has been banished by marketing mavens in favor of lifetime income. And yet, if you ask people whether they want their retirement to be protected from market drops, a very large portion of them would say yes, and do say yes. This pension nostalgia has not gone unnoticed. David John, in addition to the co-author of the previous paper, a co-author of this paper, has worked with virtually all of the states that are considering legislating auto IRAs. A surprising number of those bills include a provision directing the board that designs the program to try and provide some sort of guarantee. California, which passed the first such bill, and Maryland, which passed the most recent one, both originally included a guarantee provision. So interest in guarantees was widespread, and yet none of the states that have thus far enacted an actual secure choice program includes a guarantee. That conundrum is the reason for this paper and this panel. After Bill Gale presents the paper, he'll be followed by two discussants, each of whom has too many distinctions for me to list them all. Fortunately, we do have their full bios. First, Olivia Mitchell, Distinguished Professor at Wharton, Director of the Pension Research Council. And then she'll be followed by Andrew Biggs, Resident Scholar at our new neighbor, AEI. Welcome to the NABE. And also former Deputy Commissioner of the Social Security Administration. We'll follow that with a discussion first among ourselves and then take questions from the audience. Bill, David, and Brian Kim, to whom I should give credit as well, titled this paper, "You Get What You Pay For." They could have just as well titled it, "There's No Such Thing as a Free Lunch." This menu has a price list. And so, without further ado, to take us through the menu, the Director of the Retirement Security Project, Bill Gale.
Josh just got himself a new job as the person who's going to introduce me all the time. So as he mentioned, the title is "You Get What You Pay For." And this paper, as Josh mentioned, as hinted at earlier, is a response to the efforts at various state levels to the discussions that have been going on about guarantees, about the state requiring that pension plans provide guaranteed rates of return. No state has done this yet, as far as I know. California, Connecticut studied it. Maryland discussed it, but this issue is not going to go away. It's been around. Olivia may well talk about Social Security and the discussion of guaranteed returns there and the privatization episodes 10, 15 years ago. In any case, our goal in the paper is to highlight some key issues related to this point, and the one that just jumps out after looking at the literature and the policy discussion is this notion that guarantee costs resources. It costs money. It's not a free good, and I'll talk through that in some detail. So we conclude. Let's start with the conclusions. We conclude you could have guarantees. Guarantees do exist in pension plans around the world and some plans in the United States. But relative to the popular discussion, the benefits do not seem, in our estimation, to be as big as one might infer from the popular discussion, and the costs are considerably higher than one might infer from the popular discussion. So let me give some background on guarantees first, and then talk about these issues. The notion of a guaranteed minimum return sounds simple, but as we learned in the earlier session, simple concepts can get very complicated in implementation very quickly. So the actual minimum can vary. You could have a zero nominal return, a zero real return. You could have a fixed, you could try to have a fixed real or nominal return. As an aside, if you have a guaranteed return that's higher than the risk-free return, finance tells you you can't insure that risk. But some guarantees are listed in terms of real or nominal returns. Some guarantees are listed as reference to some other asset. So the S&P 500 or the Treasury bill or the 10-year Treasury rate or something like that. So the actual guarantee can vary. It can apply to returns on contributions, on all the contributions you've made in a given year, or it can apply to contributions you've made in a given year going forward, or it can apply to all your past contributions and the return in the given year. All right, you can design this lots of different ways. It can be constant, it can vary. It can be checked or enforced annually or upon retirement or upon job change. There are every variation you can think of someone has tried somewhere. What all these guaranteed minimum returns have in common is the following: that if the investment earns less than the return, then less than the minimum return, the insurer tops off the amount. It pays up. So the saver gets whatever that minimum return is. If the actual return is higher than the minimum return, then nothing happens. The saver keeps the money. The insurer doesn't make a payment. So from a finance perspective, the saver obtains a put option from the insurer. All right. Now, what are the benefits of these things? The first thing to note is, for most people, the core retirement package is Social Security and Medicare. And that provides a base, and we can argue about whether that base is adequate, but for purposes of the discussion, the important point is that the importance of risk in returns declines as the base increases. For those who have the base plus a large amount of retirement saving, the guarantee does not seem to be that important, precisely because they have a large amount of saving. For those who have very little retirement saving makes up a small portion of that overall portfolio of Social Security, Medicare, and own retirement savings. So again, there are questions about how valuable the guarantee is. Now, you can do all this formally, but we're doing it very intuitively at this level. And then those are the gross benefits. The net benefits have to take into account that someone has to pay for this, and unless it's taxpayers, it's going to be savers. The insurance companies, the provider of the guarantee, is not going to pay, is not going to bear the burden of the guarantee. Either the saver is going to buy it, or taxpayers are going to be left holding the bag. Okay? In terms of the cost, this is where the public discussion really gets lost. The cost typically is recorded as the inflows and outflows to the government budget. That is a problem for two reasons. One, typically you're discounting at the government's borrowing rate. But second, you're focusing on cash flows. You're not focusing on the opportunity cost, the resource cost of giving that guarantee. The economic costs, the resource costs, the opportunity costs should not depend on whether the government or private sector is issuing the guarantee. So using government borrowing rates and using government cash flow is going to systematically understate the resource cost. But that's the easily comparable thing to do, and so that's what often gets done. All right, so let's talk about who pays for this. Obviously, if there's no charge, if a state government were to require that employers provide guarantees, one option is that the state could pay for it, taxpayers could pay for it. The more likely option is that savers will end up paying for it in some form or another, some explicit or implicit form. The most obvious way savers would pay for it is if they paid a premium, just like an insurance premium. Now you might say, well, the firm might, maybe we could require so that the firm pays the premium. But most of the evidence suggests that workers bear the burden of those costs, just like they bear the burden of the employer share of the payroll tax. And most economists feel, myself included, feel that workers end up bearing the burden regardless of whether the burden is placed on the explicit burden is placed on the firm or the worker. All right, the second option is what's called rate of return collars. And the idea here is, sure, the saver gets a minimum guarantee, but the insurer then caps them at a maximum return. So a collar might be, we're going to guarantee you a minimum of 2%, and then anything above 6% we're going to claim as the insurance company. And the saver then is paying for that in that they are foregoing the chance to get returns higher than 6% in the example. So in the few years when it returns 10 or 12 or 15%, the difference between that and 6 goes to the insurer, and in the other years, the insurer is making sure they get at least 2%, say. I'm making up the numbers, but that's the type of range that people often talk about. So just as an aside, if you have a plan with a fixed rate of return, where the minimum return is the maximum return, all right, that's a collar. It's just a very compressed collar. It's a very, very tight collar. A third option is portfolio constraints. That is, an insurer can tell the saver, all right, we will guarantee a return, but in exchange, you have to do the following. And this is where the real mischief comes in. Because if you want to guarantee somebody a T-bill return, they can do that themselves. All they have to do is stick their portfolio in T-bills. If they want a guarantee of an S&P 500 return, they can do that themselves. They just put their portfolio in an S&P 500 index. And so this guarantee is virtually costless to the insurer. There's always administrative costs. But in terms of the economic risk being borne, it's costless to insurer. But at the same time, it's worthless to the saver because they can do it themselves. The fun and games come in when savers decide that they want the T-bill guarantee, but they also want the option to invest in the stock market. All right, and then you have mismatched risks, you have mismatched assets and liabilities, and this is the sense in which, in popular discussions, people think they can get something for nothing. They can invest in the stock market, but hey, if the stock market has a really bad year, they're guaranteed the T-bill return. Well, those type of guarantees are very expensive in terms of the resource costs, the opportunity costs that's provided, that is created. And so this is sort of the prototypical poster child for high-cost guarantees where the costs are not accurately reflected in the budget. The last option is to have a reserve fund. So in this scenario, the pension fund provider or the insurer would say, we're going to give you a guaranteed return of, say, 3%, but we're going to manage we're not going to give you all of the returns. We're going to manage the returns to build up a reserve fund so that in years when the actual return is less than 3%, we have some resources that we can add in there. And there's the TIAA traditional annuity actually works this way. And Teresa Ghilarducci had a well-known proposal a couple of years ago that also would work this way. And of course, the key here is what is this minimum return that's being guaranteed, and can it actually be guaranteed? TIA, I think, has a pretty good record over the years, but the return on that account still is lower, significantly lower than what you would get in the stock market, for example, precisely for the risk reasons I mentioned. And so here, again, the saver is paying for this. Well, the way they're paying for this is they're foregoing the big upside of the return. They're allowing the insurer to take the big upside and stick it in the reserve fund. So there's no mystery here. It's sort of like if you don't see these last four ways I've discussed, the premiums, the collar, the portfolio constraints, the reserve funds, it's sort of like if you don't see the way that the saver is actually paying for this, then you don't get the idea. Okay. So let me just summarize real quickly. It's definitely possible to provide guarantees. I didn't go into this, but other countries do offer some guarantees. Some of them are public plans, so it's cheating in the sense that the public sector is the backstop there. But some plans in the U.S. also provide these. But there's no way around the fact that they have to be paid for. If savers don't pay it, then taxpayers will be left footing the bill. And so without commenting on each and every detailed specific case, this is our thinking about guaranteed rates of return in pensions. Thank you.
Good morning, ladies and gentlemen. It's a great pleasure to be here. This has been quite a week for retirement topics. I came in on Monday. There were 3 days at the World Bank on retirement pension reform around the world. There was a thing here yesterday at Brookings. There were, I think, 2 sets of testimony hearings on retirement. So I'm very delighted because, you know, it's been quiet in our neck of the woods for quite a long time. So thanks to Brookings and Bill Gale and Josh Gottbaum for including me in the proceedings. So I just wanted to elaborate a little bit more on some of the topics that were touched on. And as was noted, there have been a number of pension guarantees tried around the world. Japan actually put in place a 401k plan and suggested or insisted that one of the 401k elements on the retirement menu had to be a principal guarantee option. You didn't have to pick it, but it was there if you wanted. The argument being that a lot of people were used to investing on their own in the 401k marketplace or the equivalent in Japan, and so this would be a way for people to get their feet wet. In Chile, for many years, they've had since 1981 a defined contribution mandatory scheme. 10% of pay must go into this scheme. And the idea there was they said all the money managers had to earn a rate of return on their investments that were within a plus or minus 2% tunnel of the average across all the investment managers. So the notion was if somebody ended up making a lot more money than average, they put it into one of these reserve funds. If somebody ended up losing money below that 2%, they had to dip into the reserve funds. And if one of the money managers couldn't make it, then they were absorbed by the other money managers. So that's only one piece of the regulation. There's a lot of other regulation about you can't hold assets that are too risky to make sure they can hit this target. But so there has been a lot of experimentation. And as was pointed out, there's a lot of interest in state pension options that are being discussed now. And it has applied to cash balance accounts in the U.S. as well. So it's not a strange beast that we've never seen before. When I served on the bipartisan President's Commission to strengthen Social Security back 15 years ago, And of course, I was reminded how long it was because it was the year of 9/11 as well, unfortunately. But so the commission was asked to think about guaranteeing returns in the private piece that would be the optional opt-out if people wanted to do that. And the commission did not go the guarantee path, basically saying, as Bill Gale so cogently pointed out, you get what you pay for. It's not a free lunch. So basically what we've done is, and there have been other people that have looked at some of these models too, but to notice that the way, this doesn't work on this screen, does it? So the way we have one of these too, where the lines mess everything up. So the way the guarantee works is that if your individual account, your investment account is high enough, the guarantee is not in the money. But if your return or your assets fall below a certain floor, then the guarantee starts to pay out. But you basically need to have a model of how you think capital markets work and returns and stochastic volatility to be able to estimate what the value of that protection is. The retiree gets the maximum of a guarantee payment, which is 0 if you're doing well, or the floor minus how much is actually in your individual account. So that's the quick approach to it. It's very important to understand, and the paper does a great job pointing this out, that depending on a whole host of assumptions, you're going to get very different cost outcomes. So for example, our analysis for the commission assumed that you put your money in from the moment you started working, and the guarantee would only kick in at retirement. So you were not allowed to take money in and put it out every single year. If you do that, that's a lot more expensive. The guarantees, as we said, could be various. We assumed annual contributions, but again, this is all simply modeling. You do have to be very careful and very upfront about what kind of a model you have for investment returns and correlations across the returns. Because as we know, capital market outcomes are stochastic, and you have to decide how you're going to model that. And so that's what we did in our model. I just wanted to illustrate, to give you a sense of magnitude, how big these costs can actually be. So the base case was an investment horizon of 40 years. You start at 25, you end up pulling your money out at 65, for example. Let's say you were holding an investment portfolio of half stocks, half bonds, and you wanted to set up a design such that you could earn the rate of return on bonds at the end of 40 years, and that was what was being guaranteed. We costed that, and it's basically 16.1% of every contribution every year over the 40 years. This is a pretty big number. And so then I ask you, would you be willing to pay 16 cents out of every dollar for a guarantee payable in 40 years? And the guarantee is only the bond return? Some people would, but I guarantee you a lot of people wouldn't. Then if you also look at some of the different assumptions, the impacts on them, if you ended up guaranteeing only a 10-year period instead of a 40-year period, the cost would be a little bit less, 8.1% of each contribution. This comes as a bit of a surprise to some people, because some people think, well, if I hold stocks in the long run, aren't I going to get money, more money than otherwise? And the reality is that the volatility of stocks increases over a longer holding period, and that's why the cost is double over 40 years versus 8% for a 10-year holding period. We also said, well, what if we let folks hold 100% stocks, but then gave them only a bond return? That's really expensive. So a third of every payroll dollar contributed would go into the account, meaning you only have 67 cents left to invest. And a principal guarantee, that is, you get your money back, nothing more, nothing less, after 40 years, is virtually free. Because, as was pointed out, you could invest in treasury bills and end up fully protected. The financing issue really is where the rubber meets the road. Some folks, some countries have self-financing. By that I mean the participants in the system have to pay premiums to cover their eventual guarantees. The problem is, if it's an optional program, some people wouldn't be able to afford it. And so then you have to decide what to do if they're not going to be able to afford it. In a pay-as-you-go system, you're going to have, you're going to have the fact that The positive is it will be a universal system, but then the negative might be that you'd have to go rely on taxes or other government debt to try to keep it going over time. So just really by way of conclusion, I just wanted to emphasize and underscore the notion that guarantees are not free. There was an ancient Chinese proverb quoted to me one time, I think it's accurate, that said, the couple that goes to bed early to save on candles ends up with twins. The notion is you cannot avoid risk. It just transforms itself. And so ultimately, the policy question is, are the guarantee costs really worth the benefits? And if so, to whom? These are just some references, some of the work that we've done in this area, but I congratulate this team on having brought this question back to bear in this context where it's very much an active consideration, especially in the state plans. So thanks very much, and let me turn it over without further ado to my co-commenter.
Should I speak from here, or? Okay, well, I'll go from here then. I thought I was going to be sitting down. I don't want to violate the schedule. Well, thank you very much. It's nice to be here today. I had prepared sort of written comments, and then when we were sitting there this morning, I rewrote them all, so I'm just working from notes instead. The idea of guarantees on retirement accounts has gotten increasing prominence in recent years. I'm glad we're having this event today to talk about it. But when I think about guarantees, I've done a fair bit of work on them in the past in connection with the idea of Social Security personal accounts. They strike me as a little bit like the ideas of eat more while losing weight or pay less for cable. They're these things that sound really good, but at the end of the day don't come out very often. There's the president of BlackRock Investments who's involved with the Teresa Ghilarducci plan that Bill Gale mentioned. He's written the guarantees for retirement accounts, or I think his phrase were essentially costless. And yet, if you actually go to BlackRock Investments, I would be guarantee you they will not, Blackstone, sorry, they will not give you a guarantee for nothing. And I think one of the nice things about the paper is that it illustrates the types of guarantees that can be offered. I don't deny that financial engineering can give you the type of guarantee that you're looking for, but it's also really helpful in thinking about the costs that are involved with doing that. One example, in the papers, the TIA CREF annuities, which are with collared returns on them, that you have protection against the downside, but then you give up some of the upside in order to pay for it. I'll just give a quick example of how that would work, and Bill even mentioned a very tightly collared return. If you think about it, imagine if you had some money, you put it in stocks with an expected return of 8%, but you don't want the expected return, you want a guaranteed return. So you can buy a put option with a strike price equal to your initial investment compounded at 8%. That put option is an insurance policy that will guarantee you that you will get no less than 8%. Now that's going to cost you some money, so you can partially finance that by selling a call option that would give away any returns you got in excess of 8%. So you've got this portfolio, you're invested 100% in stocks, but you have a guaranteed return for 8%. But of course, you've got these upfront costs. And the insight of thinking about how markets price this is that the protection against the downside costs a lot more than giving away the upside. So if you took your initial investment of $100, plus the cost, the net cost of these put and call options, which is around $89 or $90, you say, okay, what sort of return am I going to get on that? The total investment, the return is exactly equal to what the riskless rate of return is on Treasury bonds. So if you're getting a riskless return, you're paying for a riskless return. I think that's the kind of insight to think about of why these sorts of things are expensive, why they're not offered very much, and it's important to pay attention to the costs here. If you look at state and local pensions, state and local government pensions, what they are doing, if you look at the math a little bit, is essentially they are guaranteeing participants a 7 to 8% annual return on both the participants' contributions, but also the government's contribution to it. And the problem with state and local governments, they're not putting any price on this. And anybody who thinks these guarantees are essentially costless should look at state and local budgets these days. I mean, they are now paying the cost of that guarantee, and the problem they had is they did not acknowledge the cost up front. So it's I think one of the real benefits what we have here today is saying, yes, there are benefits to the guarantees, but there are also costs to it. When I think about what role these can play in retirement saving, I like economists' idea of revealed preferences. As Josh said, if you ask people, in an opinion poll or just informally, would you like a guaranteed return or some guaranteed floor for your 401k account? Everybody's going to say, sure, I'd like it. Ask that same person how much of their 401k they have invested in stocks. It'll probably be 60% or so. What that tells me is, sure, they like the guarantee, they're not willing to pay for the guarantee. And that is the key part of, if you want the guarantee, you're going to pay for it. Again, these guarantees can structure returns, and the pattern of outcomes differently than what a normal portfolio would give you. But at the end of the day, if people really wanted to had a safe retirement income and they're willing to pay for it, they would not be holding the kinds of investment portfolios that they do today. One last thing I'll touch on. These sort of very explicit financial guarantees, they're sort of easily priced, and I think that explains why the state-run retirement plans have not gone in that direction. I know Connecticut, they had a commission that looked into this idea of offering a guarantee as part of the retirement plans. They just said, look, it's very, very expensive to do, and most people wouldn't be willing to pay the cost for it. What you're having now, though, is more of a shift into things like in the multi-employer pension world, you have things called composite plans, where it's sort of not a financial guarantee, sort of an actuarial guarantee, where they're trying to spread the cost of this guarantee among the participants of the plan. That it may not be a strict, rock-solid guarantee, but it's smoothing of returns over time. But I think the key thing here is just because you're not pricing the guarantee doesn't mean the cost doesn't exist. And so you want to think about essentially the participants of the plans are offering these guarantees to each other, and they need to know how much they're going to pay for it in terms of both their contributions and the volatility of the benefits they'll get at retirement. I tend to think that once people really understand that, they're going to be a little bit more wary of things. So, the experience I have working in the state and local pensions, which are in disastrous shape because they ignored the cost of investment risk, is if we're thinking about options for individuals going forward, we want to make the cost of those guarantees very explicit, and ideally you want to have the people who are getting the guarantee bear that cost so that we don't get this mismatch that's created such a problem for state and local government. Thank you very much.
Part of what I would like to do now is to make this a little harder. I don't think there's anybody on this panel who doesn't think that the notion of guarantees has a cost and that the costs are real and substantial. But we also know that consumers of retirement products, financial products, are not what Sims used to call educated consumers.
Your best customer.
Yes. And so part of the challenge, if you will, is that you're not going to be able to have that informed discussion. You're not going to be able to say, would you accept a 8%, a cap of 8% on returns in order to get a 2% floor or a principal floor? In the world of retirement policymaking now, what has happened is, as we all know, the decision-making has moved within the 401k choices as 401ks have tried to emulate some of the benefits of defined benefit plans to designing a qualified default investment alternative, which I managed to mispronounce already once to date. Thank you, Olivia. As it happens, United Technologies, a couple of years ago, developed a unusual, innovative one. They said, our default is going to be a target date plan, but beginning at age 50, if you do nothing at all, part of that money, of your money, is going to buy an annuity that starts paying when you hit 65. So the question is, recognizing that these are costs, is that a good idea? Is that a bad idea? What's your view? I'm trying to get you to find there's a trade-off. How would you judge that trade-off?
For the standard plan like that has people putting in 2/3 stocks, 1/3 bonds, and the target date hitting, they accumulate it in those proportions till a target date. Mark Avery and John Turner had a proposal, RSP proposal, actually, probably 6 or 8 years ago, that said that you should take that 1/3 that you're putting in bonds and just start buying annuities with it. And the idea there was to smooth out the interest rate risk that occurs over time. You don't want to save your whole life and then annuitize things that everything in one fell swoop at 65 if interest rates happen to be really low that year, because you'll get a lousy annuity. And so they had that proposal as a way to smooth out interest rate risk, which I thought made sense.
So this is, I think, part of a broader move that the current administration has been pushing, and Mark Avery's name has already been mentioned, I think, who's spearheaded this effort, to try to, quote, put the pension back in the pension plan. In other words, put the payout stream back into the menu of alternatives that people can select from their 401k plans, either before they retire or after they retire. And I think that it's a very good idea, but not for everyone. Some people are already over-annuitized. That is, they have a lot of Social Security, especially relative to their lifetime wages. If they've been a low-wage worker their whole lifetime, they're going to have a very high Social Security replacement rate. If they also have a house, in a sense, that's an annuitized consumption stream as well. And so those folks probably don't want to be annuitized any further. Also, we know that people who are low wage and less educated tend to have higher mortality rates. And so using a population life table to price annuities for them is going to be very unattractive. So I think we have to be a little bit sophisticated about who's going to be annuitized and who won't. On the other hand, if you're a medium or a high wage worker, so Social Security isn't replacing all that much of your pre-retirement wage, and you'd like to have a lifetime income stream, I think that's brilliant. The other point I would note, though, is that the best form of an annuity is a deferred annuity. Instead of like UTC, where the payouts begin at 65, you can really buy yourself a lot of lifetime income protection if, when you're 50 or 60, you buy yourself a payout annuity that begins at 85. It's really cheap because not everybody lives that long. But the appeal is that if you're still on God's green earth, consuming and spending, the deferred annuity will be there to support you. And a final point, since I'm a big fan of deferred annuities, is that we had a conference this year at Penn on cognitive aging and financial decision-making. And at some point, lots of folks, maybe half, are going to get dementia of one form or another, they're not going to be able to make their asset allocation and payout decisions. So I started thinking about this when my own mother, who was 94, stopped being able to handle her own finances, and guess who had to do it? You know who. If she had had an annuity, it would have been a whole lot easier for me to manage her end-of-life affairs.
All right, let me push back for a second on that.
Sure.
Because while I agree with everything you said, we know that when people are asked the question, do you want to buy an annuity? In other words, when they're asked the full question, do you want to buy this, and here's what it costs, they tend not to do it. When they're offered deferred annuities, they are even less likely to do so. So the question is, knowing what you know both about rational choice and about behavioral economics, would you be in favor of essentially putting a deferred annuity into a qualified investment default option?
There are a couple
or do you
points.
think that's taking away too much discretion?
There are a couple of points to be aware of. One is that the people who are most financially literate are also those who understand annuities the best. And I think we have a huge task ahead of us to try to educate the American people, ideally from high school forward, more about retirement, saving, investments, diversification, inflation, and so on. So more financial literacy would enhance the demand for annuity. The other point that I would make, and this is no surprise to you, I know, that many employers have been reluctant to put payout annuities into their plan menu. Why? Because they fear the insurance company that will be doing the payouts for the next 30, 40 years might go bust. And then the participants may turn around and sue the employer for fiduciary liability. So I think that's a huge topic that we really do need to try to figure out, either figure out a safe harbor or maybe through a platform where various different insurance companies can provide products, but that's a big stumbling block to date.
It just, I mean, again, going back to the idea of revealed preferences, I mean, I'd be a little bit, I mean, I understand the case, you know, for annuities in the theoretical sense of longevity risk. But, you know, we simultaneously have, you know, the claim that Americans are excessively reliant on Social Security while also saying they're under annuitized. But, you know, it gets back to the point you made and you thought about guarantees. The people, you know, who, the people who don't have annuities are generally have a lot more wealth, and it's just not, I just don't think it's a practical problem for them. But there may be rational reasons why people would not want to essentially, I don't want to say forced into an annuity, but defaulted into an annuity. I mean, the mortality risk issue for lower income people, they may not realize it, but once they do realize it, that's going to be a real problem if they feel they're being pushed in that direction. But maybe they want liquidity. Maybe they want to be able to control, you know, their consumption patterns over their retirement. I mean, the idea that everybody is going to consume the same amount each year doesn't hold up in the data very well. People do tend to consume more at the beginning of retirement, less at the end of retirement. So, you know, there might be actual reasons that they have for not wanting this. So I definitely agree it should be made available, and you know, it's a problem that you don't have them very much in 401ks now. But you know, I'm a little reluctant. If people are already getting most of their retirement income from Social Security, where we've told them how much they're going to save and how it's going to be invested and so on, you know, there's some, you know, window for individual discretion.
So you would, I'm not trying to put words in your mouth, but I am trying to understand where you are on this divide from requiring it to merely offering it to making it the default. Would you?
I would not make it the default.
You would not make it a default.
So
Okay.
They already have an annuity.
You can't default people into annuities. I mean, if automatic enrollment and automatic escalation of contributions are great, both because they get people in the system, they raise contributions, but they also have a feature, which is if they got the contribution rate wrong, or if the person really shouldn't be contributing, it's relatively costless to get out of it. Somebody puts in 6% for 6 months and they realize, oh, you know, I really shouldn't be doing this for whatever reason. It's no big deal to stop it and get the money out. If you automatically annuitize someone into the wrong annuity, That's a lifetime commitment. Olivia just gave all the reasons why annuity demand is going to vary dramatically. And so you don't want to just kind of have somebody stumble and you wake up one day and say, oh, I've been automatically enrolled and here's my lifetime income profile, but this is not suitable for me. So David and I and Mark Avery and a woman named Lena Walker, also an AARP employee, several years ago came up with an idea, address this question: how do you deal with annuitization if you want to harness the power of automatic saving, but you don't want to commit people to the wrong lifetime annuity? And what we came up with was the idea that when people left their job and were ready to take their 401k, they would be defaulted into 2 years worth of monthly payments, as they couldn't take the whole thing out. They would have a test drive, basically, of the notion of monthly payments. And that would be automatic. But then at the end, they could choose not to do that. They could choose to take the lump sum. They could choose to extend it or whatever. So it was sort of an automatic but temporary annuity. I know that's kind of abusing language, but that was the notion, this test drive, and that was the best we could come up with for a way to make it automatic, but not commit people to the wrong path.
So you would be okay with defaulting people into the test drive annuity?
Yeah.
Why don't we open it up to the audience? The basic rules in Brookings are, I've learned, one, you have to say who you are and if you have an affiliation. Two, your speech has to end with a question mark and should be shorter than the time it takes us to answer. Okay. The lady in the last row.
Mary Ellen Signorelli, AARP Foundation. When I was on the ERISA Advisory Council, UT came to talk to us, and one of the problems they had is that when people went to retire, they would cash out the annuity. And so my question is if you're going to do some sort of default, how do you prevent that from happening?
Well, this is exactly what the test drive was aimed at. People don't have a lot of experience with taking a large sum of money and converting it to a monthly payment, and this is what we used to call the big small problem. If you go to your Thanksgiving table and tell your family members, you give me $100,000 and I'll give you $500 a month for the rest of your life, they'll look at you like you're nuts, right? And so the test drive idea was to get people used to this idea to see if they were okay with it. If they weren't, then after 2 years they could cash out. I mean, at some point it's their money. If they really insist on cashing out, there's only so much you can do, but you can at least show them the benefits of monthly income.
I guess the point I would make about annuities is that they're a different they're a different asset than stocks and bonds. So the deal with an annuity is that you put your money in, and everybody in the risk pool puts their money in, and then based on survival curves or mortality curves, he or she who survives gets to benefit from the assets of the person that passed away. And in this sense, it's totally different than a stock or a bond. When you buy a stock or a bond, you get the capital market return. But the real benefit from the survival curve, or the place where the mortality really starts to kick in, is around 80, 85, 90, 95. And so if you think about cashing in an annuity right away at 60 or 65, it's not that appealing. The real benefit comes is if you buy a deferred annuity where the mortality curve starts to really play a key role, and then you can earn a lot more than a typical capital market asset in expectation. Of course, only if you live. So that's the name of the game that you're playing.
So does that mean that since it's a different asset class, that an appropriately diversified portfolio ought to include some form of deferred annuity?
Depending on your other wealth, if you're already rich enough that you don't care about longevity, or the other issue is if you're really poor, and if the annuity payouts would be held against you for all our means-tested programs, right? Medicare's means-tested, Medicaid's means-tested, SSI. So if those payments would be held against you for those other poverty-type programs, then maybe it wouldn't be a good idea.
Hi, Arun Muralidhar, and I was a consultant to the California Secure Choice Board, and I testified in Connecticut to try to kill the guaranteed return. And I wonder whether in all these discussions we're going down the wrong path, because what we're trying to get out of these systems is a lifetime income stream of some kind, where everybody can choose their target. But sadly, the focus has gone on to portfolio choice, guaranteed return. So I wonder whether we need to change the dialogue to saying, what's the objective? And then these are all mechanisms to help you achieve that.
Want to react?
It's easy in all these debates to lose track of what the objective is. And as Seth was saying earlier, you take one bite at a time, and it's definitely helpful to think about what it is you're eating as you're taking a bite of it. Yeah, no, so I agree.
I'm going to step out of the moderator's role. The reason I started mentioning that this all began with the Employee Retirement Income Security Act is because that notion, I believe, underlies all of this, that the reason why people talk about guarantees is because they want stable income. But we've gotten ourselves into a place where the dominant form of retirement savings products don't guarantee retirement income. And so the question is it worth it? The reason this panel raised the question is it worth it going back to that, bringing it back? And as you can see, there's a range of views.
I mean, I think the reference to ERISA, though, is helpful in the sense of, broadly speaking, ERISA said if you're promising people a benefit, you have, with a vesting requirements, you actually have to pay them the benefit, and you actually have to fund the benefit. And it became evident that the employers were willing to offer these benefits as long as they didn't have to pay them or fund them. Once you pass ERISA, they said it's not, we don't want to offer it anymore, or the offset to the workers' wages is not enough. They're not willing to bear. And the same with state and local pensions now. They're happy to offer the pensions as long as they don't have to fully fund them. So I think that raises the issue of the guarantee, because in essence, with the defined benefit pension, you're guaranteeing against the market risk. And I think it illustrates the issue of, are people willing to pay the price to get rid of the market risk? And the fact that so few people invest heavily in bonds tells me no. So it's just it's a trade-off they're not willing to make.
And yet, TIAA, the Teachers Insurance and Annuity Association, still covers some number of hundreds of billions of dollars, et cetera. So I think the challenge we have is there are some people who clearly will pay. There are a lot of people who clearly won't.
Oh, very risk-averse crowd.
Yes.
So I have a comment on that because I've studied the TIAA. It's called a participating annuity. It's unique in the US. This type of model does exist in Europe, but because of special dispensation under federal law, TIAA is the only annuity provider in the country that can do this. And what they do is when participants buy in, they share in some capital market risk. But the other thing that's unique is they also share in mortality risk of the pool as a whole. And so other annuities they have capital market risk, but they don't have participation in the mortality risk. So what this means is if there's a shock, not to an individual, but to mortality for the group as a whole, then the participants who are going to be receiving benefits under that scheme will either benefit. If everybody dies all of a sudden, leaving you're going to get a ton of money, or have their benefit reduced. That is, if everybody lives another 3 years, you're going to end up having your benefit cut. But this is a unique product which nobody else can offer under the law, and I think actually it would be useful if they did. The benefit to the insurer, which then passes through to the participant, is the insurer need not hold a reserve for mortality shocks. Every other annuity provider in the country must hold a reserve. Therefore, the annuity is much cheaper. Now you can say, well, maybe participants wouldn't like it because their benefits will be fluctuating in some unknown way. But what we've shown is that for reasonable risk aversion parameters, that actually participants are much better off pooling the mortality risk and taking the capital market risk from this participating annuity. So I don't work for TIA. I just think it's a very clever product. Europeans do it. Why don't we have more of it?
I think it's helpful that you mentioned the two things together. You have a pooling of an annuity risk, and then you have the market risk collar there. And I think it's important to recognize that these are different things. Some of these ideas for the composite pension plans and these guarantees, people will talk about them, oh, we just need to pool all our risks together. Mortality risk is something that you can pool. I mean, the risk that your house is going to burn down in a given year, that's something you can pool. Investment risk over time, I mean, is not something you can easily pool. You can pool it over short periods, but it really does next to nothing for you. If you try to pool it over long periods, you either need to build up the fund first, or you're going to sort of give a freebie to the first generation, which may kind of lead to an underfunded plan later on. And so I think there's this misapplication of risk pooling to investment risk, which just doesn't work in the same kind of way.
Yeah, the only thing I would say is the TIA product pools mortality risk within a cohort, but if there's a shock to mortality for the cohort as a whole, that's what the participants bear. So we also have to understand that all mortality is not the same. You can quote me on that.
In the long run, we're not equally dead.
Right.
One last.
Yes. I'm going to engage in self-dealing and let the pension advisor of the Brookings Institution ask a question.
Thank you. Bob Toth, I'm actually unaffiliated. The question is transparency. Unlike other asset classes, you know what it's going to cost you for the investments. Have you thought about the impact? You don't know if you're buying a well-priced annuity or not. Have you thought about the impact of that? You don't know. And I think it impacts each one of the conversations you had in a variety of different levels. Is that, would that be helpful? Have you thought about it? What does transparency do? There is no way to find out. When I bought an annuity for my mother, I sat down with an actuary who specializes in this kind of thing, and we worked it through. But not everybody can do that. Josh, thank you.
I don't know annuity markets well enough in the practical sense, say how much, for the same product, how much variation is there? You'd think with internet pricing that would have squeezed it down, but I'm not. It may be so few people buy annuities that it's just an inefficient market.
Well, you could go to annuityprice.com or a number of them. The issue, though, because we regulate insurance at the state level, is that every state is going to charge a different amount. So they tell you that you're in Pennsylvania and this is how much you pay. But I highly encourage you to do it because you can learn a lot by seeing how much annuity and deferred annuities cost.
Yes. One last question, the gentleman in the back.
Hello, thank you very much. My name's Ed Bartholomew, independent consultant. Very interesting what you just said on the TIA, which I understand is not available to everybody. It's just available to people that are participating. I love the concept of the deferred annuity, but what I worry about is the following. You're buying something 20 to 30 years in the future. They're typically nominal annuities. You don't know what a dollar buys in 20 to 30 years. And to your point about a mortality shock that could hit all insurance companies, so you may be faced with a situation at 85 when you're demented, your insurance company goes bankrupt or it buys much less. So who takes that risk, and is it really reasonable to put that risk on people? And why is the participating annuity not being pursued as a more robust alternative that's available to everybody?
A lot of great questions. Most states, because we have state insurance regulation, which, by the way, I think we shouldn't have. I think it should be federal, but that's a separate issue. Most states have solvency guarantee funds. So any insurance company operating in the state, selling in that market, would have to kick in to try to bail you out if you had bought an annuity. I talked to one of my colleagues who is another annuity guru, or at least junkie, and he owns 14 different annuities bought from different states to benefit from the insurance guarantee fund. So maybe that's the story.
Wow.
This is a market which is far from transparent. I want to thank the panel. I want to give the last word to the director of the Retirement Security Project. Bill Gale.
Thank you. I want to thank you all for attending. In particular, thank Rebecca Sundin for all her work organizing this conference. Thank you. Thank you.